Yeah, excellent. Excellent. Thank you, John. And welcome everybody who's chiming in here today. Thanks for joining us. We're going to talk about small business financial reporting. And I don't know if you can see this on my screen. I don't, forgive me, I don't know how to share it, but just to kind of give you an indication of who's on the call today, the three questions that John just asked: what stage of business are you in currently? We ironically have about a third, a third, and a third. So about a third of the people looking at starting a new business, about a third who've been in business 1 to 5 years, and about a third who've been over 5 years. So a good mix today, which is great. And then the second question was, how many employees do you currently have? The good majority, about 2/3, is just me. And then the other two pieces, the 2 to 10 and the 11 to 100, made up about 20%, 15 to 20% each. So just, again, trying to figure out who's on the call today. And then the one that I'm most interested in seeing the results of is, how would you currently rate your understanding of your business financials? Again, a good mix here, but I've got about 25% of you saying that they scare you and you have no idea what you're looking at, which is fine. That's what we're here to talk about today. And then about a little bit more than half saying, I understand a little, but want to know more. Perfect. Those are perfect. And then about 20% of you say, I feel pretty comfortable, and I review them regularly. So that helps me kind of level set what we talk about today, but a good mix of people here. And, as John mentioned, put questions in the Q&A, and he will either pop in and ask them out loud if they are relevant or timely or need to be asked. If not, we'll wait till the end and we'll reserve some time at the end to talk through that. So having said that, let's move forward. John read my bio to you. I'm not going to reread that to you, but I do want to point out two things. I do have my SCORE email on here, and I've got my LinkedIn connection on here. The recording in a few days, we'll have this recording out on our YouTube channel, like John had mentioned. And I will send with that, when we send that out, I'll send a PDF of these slides as well. So there's going to be some links in here. There's going to be a lot of data. Some of it I'm not going to read verbatim. So don't worry about that. Just kind of sit back and pay attention and listen. And don't worry about taking notes. You'll have those both in the recording and a PDF copy of this in a few days. So what are we going to talk about today? This is our agenda. I'm going to give you some general comments for a few minutes. Just want to kind of level set again what we're going to talk about, what we're not going to talk about. And then I really want to hone in on, what the importance of understanding your financials. Hopefully, you guys are here because you want to do that for sure. This is your, discretionary free time, but I want to really drive that point home. I want to talk a little bit about outsourcing, what you do yourself versus what you have somebody else do. And then really the bulk of it is some key financial reports. We're going to dive into those and look at this from the standpoint of what you need to know, what you need to pay attention to. We'll recap that a little bit and then do some Q&A at the end. So just to give you an idea of where we're headed today. All right, some general comments. Today's target audience is business owners, key employees, anybody who wants to really understand the financials of their business better and to make sure they're making decisions that are in line with what those financials say about them and also what their goals are. So making conscious choices about that. And this could be, you could be just thinking about a business, you could be in business a long time, doesn't matter. That for that piece of it doesn't really matter at all. Whatever stage you're in is the right stage for you to learn more about your financials. I am going to assume that you have some general idea about what your goals are or what you're working or that you're working towards quantifying them. So your goals could be, I want to make $100,000 in revenue next year, or $1 million in revenue next year, or I want to earn enough money to put money aside for retirement, or I want to earn enough to hire more employees. Whatever those goals are unique to you, that's kind of have that in the back of your head, because that's what I want to talk about as we look at your financials. You should be thinking about those goals and whether they're getting, those financials are showing that you're getting there in the right, you're moving in the right direction. The third bullet point, I'm assuming that your records are accurate and complete or on your way to getting there. So we're not going to be talking about debits and credits and T accounts and how to do an entry in QuickBooks or anything like that. And as you look at reports that come out of whatever financial system you use, if you don't have the data in there correctly, reading them is going to lead to wrong, incorrect conclusions. So, if you're not there yet, get there. That's the first step, but then we're really going to focus on how do you look at those reports once that data is in there. We're going to look at, to that point, if they're not accurate, they're not complete, or they're taking too much of your time, what type of help to look for and what you need to do along that. And then just one last point here. We won't go into depth about different types of businesses. There's just way too many nuances to cover in such, short amount of time. Most of what we talk about doesn't matter whether you're an LLC or a sole proprietorship or an S Corp or a C Corp, does not matter. This looks at the same, very similar for those, for each of those companies or each of those types of companies. And we're not going to go into details about a manufacturing company versus a service company or anything like that. So again, high level, this applies to anybody in business. But just please know that we're not going to get into that, huge detail there that for specific industries. You can certainly feel free to ask a question in the Q&A. We can, go about it that way. Or more importantly, you can reach out to a SCORE mentor to help you with your specific questions. Now, this slide I pretty much read to you. I promise I'm not reading every single slide, but this one I think I just wanted to kind of get on the same page with everybody. So that's why I wanted to go through that a little bit more. The importance of understanding your financials. Obviously, I'm a little bit of a geek in this respect, and I think it's very important that you understand your financials. They tell a story. And more importantly, for those Yogi Berra fans out there, all those Yogi Berra quotes are amazing, but if you don't know where you're going, you might wind up somewhere else. So if you don't know what your financials say about where you are and where you're headed, you're not necessarily going to get to where you want to go. So I think that's key to keep in mind. And I just threw a separate note down here for those Yogi Berra fans. There is a movie coming out next month, It Ain't Over, which will be an interesting one to watch. Nothing to do with financials, just a side note there. All right, so from a big picture, I want to first talk about a story of a company we all know, or I would be surprised if some of you don't know, but most people know about Netflix. So I want to talk about the stories that your financials tell. And this Netflix example, I think we're going to look at a few charts here, but these are their financials, but in a graphical format. I don't expect that your financials will be in this format. This is, reflects a lot of people doing a lot of work in a big accounting section of the company, but the story would be the same. So when you look at this, I want to focus on a few things. This is for their fiscal year ended 2021. Their operating profit was a little bit over $6 billion. Their revenue was just about $30 billion, which you can see when you look at here, streaming is the majority of it. Interestingly enough, I don't know if you saw in the news about a week or so ago, they talked about finally shutting down their DVD, those red envelopes in the mail section, but that was still, a very small piece of their revenue stream for 2021. So when we look at financials, we look at, okay, what's the bottom line, but then what are the big pieces? And the big pieces they made, like I said, these two big pieces, or the one giant piece, one tiny piece, is basically how they made their money. And then you can go into a lot of details about licensed content and produced content and other content. How does that break up, the cost of how they generated that revenue, and then the gross profit, as well as the marketing costs, the tech and development, all those pieces of it. But something like this is interesting to look at, just as far as how much money you're making, where you're making it, how it breaks out. It just tells a story. So I mentioned that the DVD piece was still a factor, and they just recently announced that they are going to be shutting it down in 2022. They had $146 million that they still earned, and over 1 million customers in 2022. The graphic from the last one was actually 2021, so that's why the number is slightly different there. But it's just interesting to me to see another piece of the story. It's a financial piece, but it's also a part of their story. And what I found most interesting in reading this article a week or so ago was that they started the business in 2007, which I remember that being a big market disruptor back at the time, the DVDs through the mail. But as early as 2009, they started anticipating that this would be a dying business. And so they tracked it over time and finally decided to pull the cord, even though it was still profitable. One last comment on Netflix. And again, this goes towards the story that your financials tell. And this chart is also a little bit dated because I think this is quarter one and two of 2022. I obviously do not have, intimate access to Netflix information. This is public information, so I'm limited to what I can get, but this is so interesting to me. If you recall, about a year ago, Netflix started talking about charging subscribers, adding ads, cracking down on all the people using your accounts and things like that. So one of the reasons was because they watched the trends in the subscribers. So this graph here is showing subscribers over time from 2015 to 2022. And they were losing subscribers. This is the net change in subscribers. So they were losing subscribers. So my point here is, again, I don't want you to feel sorry for Netflix. They're making a lot of money. We saw $6 billion. That's nothing to sneeze at for sure. But for big companies, small companies, everybody, profits can hide a lot of problems if you don't pay attention to them. They were paying attention to this. They started making proactive changes. They were paying attention to the number of DVDs that were going out in the mail. They started making changes to that or watching it more closely. So that's really what I want to reinforce with you. It doesn't matter size. Paying attention is what's important there. So financials tell such interesting stories. We're going to go over more today, but they tell the story of your business. And it is so important to take a step back from the day-to-day, your busy day-to-day running your business. It's important to take a step back and really understand the big picture, understand the trends, understand the seasonality, and then, use the professional resources to interpret the results. But also, and I'm going to come back to this point a couple of times, trust your gut. You know your business. You got into that business for a reason. Certainly, I wouldn't say ignore things, but trust your gut. All right, real quickly on outsourcing. I mentioned earlier that I'm assuming that your books are in good shape. I am a strong believer in you focus on what you do best, whether it's, running a manufacturing company or an HR outsourcing firm or providing a service or, making candles. It doesn't matter what it is, focus on what you do best and hire others to do the rest. But you have to understand your financials at a high level, and that's what we're going to talk more about. But if you're on the fence about outsourcing and having, getting help to do this, please seriously consider getting the right resources to help you with this. The reason being, you can make more of an impact by doing what you do and generating revenue and having the support people on your team, whether it be internal or external. All right, here's a slide I'm not going to read to you, but some of the questions I get typically are about, who should I hire? If I were to hire somebody, a bookkeeper, a tax expert, an accountant, an auditor, I've lined out for you kind of the services they provide. Are they a CPA, the benefits, the price, kind of generically. Again, not going to read this to you. This will be in the handout if you want to look at it, if it applies to you and you want to think about this more. But I really want to just focus on, can I do this in-house? So that question I've kind of lined out. And again, these are my opinions and thoughts, but from a bookkeeping standpoint and the services that are provided, if you have the time and expertise and you have somebody in-house who has the time and expertise, you could potentially do this. You have to weigh the benefits there. As far as taxes, I do not recommend that you do this unless you are a tax expert. Unless you are in that field, I would say hire somebody to do that. There are so many nuances to that. Personally, I don't do my own taxes. My stuff is a little complicated, but not super complicated, but I know I'm not on top of all of the tax changes. So highly recommend that. Accountant and auditor, and again, slightly different services. If you have somebody who has training in accounting, the skills, the time is not better served somewhere else, go ahead and do it. But again, I would consider hiring somebody for that. So if this applies to you, look at look at that separately. And then just how, again, another question I get all the time is how do I find somebody? The best way is referrals. Talk to people you know locally. Most bookkeepers, tax accountants are virtual pretty much these days. So it doesn't necessarily have to be somebody in your town, but a referral of somebody who's in that or who has worked with companies in your business is always a good thing. I've listed a bunch of questions you should ask or could ask if you were in searching for somebody, but really, ask the questions. But I think the most important point here is that you need to feel comfortable with your choice. So you need to be able to feel comfortable that this person is answering the questions in the way that, help you out, and you're communicating with them in a way that works for them and vice versa. So trust your gut at the end, but if you have that need, here's some questions to ask. Again, we're going to get into the financials right after this, but another common question I get is what software to use. QuickBooks is the gold standard for sure. There's a price associated with that, but they excel at, no pun intended, but they excel at accounting, bookkeeping services, and pretty relatively easy to use. And it's also pretty easy to find somebody who's qualified to help you. Wave and Xero are two free or low cost options that I don't have much experience with, but I know people have used them and think highly of them. That's an option. Could very well be that your business is simple enough that Excel is fine. And that, is basic, but it may work for you. So it doesn't matter what the service is. They're all relatively similar. It's just, again, getting the data in and understanding what's coming out of it. Also included in here is a link to an article that goes into more details about those. All right. So that's all the background. We're going to talk about some financial reports, which is the heart of what this whole discussion is about. So income statement, balance sheet, cash flow, AR aging, AP aging, and then a few other things I want you to consider. I've got an example in here, RFG Consulting Services. It's made up. It is not real. And it is a consulting, so a service industry, just kind of to level set there. The RFG Consulting Services will go through again in a little bit of detail, but it is completely fictional. And just so you know, I did create this in Excel. So I did not pull this from a QuickBooks or anything like that, but whatever report you pull from QuickBooks would be very similar to this. They're virtually identical. The layout is pretty much the same. All right, so an income statement. An income statement is also referred to as a profit and loss statement. So if you see those two terms, they're interchangeable. Don't worry about that. They're not two different things. And an income statement or a profit and loss statement or a P&L is the accounting record of how much money you made. So in this example here, a couple things you want to look at. The time period. So this is for the quarter ended 12/31/2022. I like to look at kind of the bottom line. So my net profit for this Q4 was $8,324. When we kind of go back, I like to look at things. This is pretty much a summary level. I like to look at the summary and then go into more detail. So I want to understand the big picture and then dive down a little bit deeper. So I made $8,324. Where did that come from? I had revenue of $18,500, and then that included a small cost of goods sold, and a cost of goods sold would be any materials you use to create that revenue. So if I were, or I should stay with this example, in this example, I provided some workbooks to some clients. And so the cost of creating the workbooks, the binders, the paper, whatever, was $1,100. So my gross margin for this quarter was $17,400. And then I had some expenses. This is expense and this is expense. And then the net of that was this $8,324. Couple points on here. We're going to dive a little bit deeper, but I want to point out a couple of things. Profit does not equal cash. So I made $8,324. That does not mean that my checking account reflects $8,324 for a variety of reasons. Profit usually does not equal your tax return. So I made a 324, my tax return might say something higher or lower. There's a lot of different nuances with how things are recorded for tax purposes. So those could be 3 different numbers and typically are. One other thing I like to look at here is kind of the trends. So I looked at this quarter and I've got, this is October, this is November, this is December, different dollar amounts. So, what does that tell me about November? Was I off 3 weeks in November? And so that makes sense. Or was I working super hard in November? And that doesn't make any sense to me at all. Or was December, higher because the holidays impacted my business? I don't know. But those are questions that you would know because you're working in your business day to day, and things to look at, things to think about as you're looking at this, especially if they don't make sense to you. If it doesn't make any sense to you, you need to dig a little bit deeper. Okay, so we're going to dig a little bit deeper in the income statement. If you remember from the prior page, we had the total revenue of $18,500. And then after that, $1,100 in my cost of goods sold, that was $17,400. So again, in my example, I broke this out. I make money in my fictional company here in consulting, in some tutorials that I do, and some workbooks that I sell. So that breakout there is very helpful. And so this would be similar if you think about the Netflix example that we looked at. This would be similar to, their streaming revenue versus their DVD revenue. So whatever makes sense to you. And this is completely customizable. This is something that you should break out in a way that makes sense so that you can track it. So moving on to the bottom half of the income statement, or our expenses. If you remember, our bottom line was that $8,324, and we had 2 major categories of expenses, that $5,675 and then the $401. And you can see the details there. And this would be kind of your day-to-day stuff, your payroll, your advertising, your insurance, legal fees, all of those like operating expenses, all the things that you need to operate the business would go into there. Again, a good thing to look at is, kind of the top fell off here, but if you remember, this is October, November, December. So a good thing to look at is like, hey, how does this look month to month? Pretty consistent here. Does that make sense? Does that not make sense? Things like that. All right, so that was the income statement in a nutshell. We're going fast, and I know that, and I appreciate that. So, please, absorb what you can, and then go back and look at this if you need to, or reach out to me, because it's a lot of content here. But the next thing I really want to talk about is one of the other main financial statements, which is a balance sheet. And a balance sheet is a point in time. So for this is for the period ended 12/31/2002. It's not for the quarter. It's not, for the year. It's for a point in time. Because what a balance sheet is, it's a summary of what you own, which are your assets. This is what you own, what you owe somebody else, liabilities, and then the net of that is the equity in the company. So at a very high level, it's what you own, what you owe, and then the net of that. Balance sheet always balances. So you see that 16,024 and then the 16,024. Their liabilities and equity together equal that 16,024. Diving a little bit deeper into that, again, I mentioned earlier, I like looking at a summary level, regardless of the statement, and then kind of diving down deeper, because I need to understand, personally, I need to understand the big picture, and then I look deeper. So if we look at just the assets, and that is what you own, you can see that what I own in this fictional company is some cash. My checking accounts add up to 6,024. I've got some accounts receivable of 2,500. And what that is I've already sold something. Somebody hasn't paid me yet, so I'm owed that money. If I had any inventory, any prepaid expenses, those would also be things that I own. The other big piece, that section is called current assets, just because they're easily accessible. You can get at your cash. In theory, you can get at your accounts receivable when that comes in, things like that. But your fixed assets are a little harder to liquidate. So if you own any real estate, any equipment, any furniture and fixtures, vehicles, whatever. In my example, I just have the equipment. Again, very simple example. But that's what makes up my fixed assets. And so it's a little bit stickier. It's a little bit harder for me to sell my equipment and get money out of it. That's why it's not considered a current asset. So a deeper dive into the liabilities and equity. Again, total is 16,024. The 8,700 is our liabilities, what we owe. And some pieces that make this up typically are accounts payable. So accounts payable would be money I owe somebody else, like a vendor. A commercial loan balance or commercial mortgage balance or credit card or vehicle loans or other debt or lines of credit. Those are all you owe somebody money. So that is the total liability section is what you owe. The equity section is made up of kind of three main components: common stock, which my company doesn't have any, so there's nothing here, but if yours does, it will show something there. Retained earnings, which is your earnings over time that you've kept within the company, and then dividends or that you've dispersed if you have common stock, which I don't, or owner's draws. So if I've taken money out of the company or put money into the company, it's not technically an expense of the company. It is just an owner distribution. So that factors into the equity section. And then we're back to the 16,024, balancing up our balance sheet. All right, cash flow. Cash flow is super important. You all know that. Cash flow is a big piece of why big and small companies, don't succeed. You can be the most profitable company out there, but if you don't have the cash flow, if you don't have the funding, you will go out of business, even if you have a great product, a great idea. Cash flow is it's a look at how, how you've spent that money or what changes have happened in your account. So if you remember on the balance sheet, 6,024 was my cash. I'll go back and show you real quickly. So 6,024 was my cash. And so for this period, for this quarter ended 12/31/2022, I have 6,024. I started this period at $4,000 in cash. There's two main categories, and this is cash flow it's a concept, a term that a lot of people don't know. So let me just explain it real quick, but you all know it. You just don't know it by this name. It's really just the cash in and out. So think of your own personal checking account as the cash in and out, no different than that. So it's the flow of cash in and out of the company. So two main categories are the cash inflows and the cash outflows. So you can see my cash sales factors in here, and then my outflows. A couple different things. Bear with me a little bit on cash flow, because I'm going to show you this is a true accounting cash flow. And in a true accounting cash flow, there's three categories. There's investing, operating, and financing. And so if you have audited financials, or if you've seen audited financials, or if you run a cash flow report out of most accounting systems, this is what it'll look like. It'll say investing, operating, financing. And so investing would be if you're buying, investing in the company, you're buying new assets, you're buying inventory, things like that. Operating is your day-to-day, your payroll, your rent, your day-to-day expenses. And then financing is loan payments, anything you're paying, any cash you're outlaying to finance the company. I want you to understand that nuance, but I don't think this is super helpful for most people. And probably my CPA friends will probably, slap me on the wrist for that. And the reason I say that is because really what you're most interested in is like this operating expense. And it doesn't really help you to look at this as one big bucket. But hold on to that thought for a minute, because I want to look at this a little bit closer too, because I think for all of these things, whether it be an income statement, balance sheet, a cash flow statement, whatever, a point in time is one thing, but a trend is important as well. So this is that same balance, 6,024. I've just broken it out over 3 months. So you'll see by the end of December, we're back to that 6,024, but I can see the nuances kind of month to month. So whether it be cash flow, balance sheet, income statement, looking at trends over time is helpful, because you can see kind of what's more normal, what's regular every month versus kind of what's a one-time thing or a seasonal thing or something that doesn't recur on a regular interval. So understanding that is important. But again, this is still the accounting cash flow. And what I really want to talk about is you looking at your cash flow from a true starting balance, ending balance, and what happened in between. And I find this kind of format particularly helpful. This is something quite honestly, you have to pull into Excel and kind of make it work for yourself. I haven't seen an accounting system do this well. I wish I did, but I haven't. But same example. So that cash position is still 6,024 at the end of the year we were talking about, the end of 12/31/2022. The only difference, or the big difference, we're still talking about the cash coming in and the cash going out. But the big difference is instead of the financing, operating, investing, I've laid out, what you would think are normal categories, what you're spending on advertising or payroll or supplies, again, so that you can kind of see the categories that make sense to you. You can look at this and say, okay, loan payments, that's great, but my last loan payment is tomorrow, so I won't have that going forward, that type of thing. And what's particularly powerful, and we'll come back to this concept, is, okay, this is what happened already, but what do I think is going to happen in the future? And so taking this concept and looking at it and kind of projecting out what you think will happen is a very powerful tool. Okay, so I'm going to take a sip of water real quick. AR and AP. AR stands for accounts receivable. Again, this is what people owe you. You've already done the work, you've already provided them the service or the goods, and you are owed that money. If you remember back to our balance sheet, we had that $2,500 that was accounts receivable. Accounts receivable on the balance sheet, $2,500 doesn't mean so much. When you look at this report, and this is what it's called in all systems, accounts receivable aging reports, this is helpful because what this tells you is of that $2,500, who owes you money, which customers owe you money, and more importantly, how long has that bill been outstanding, that invoice been outstanding. So in this example, you can see this customer F here has owed me $750 for quite some time, more than 3 months. And so this gives you a handle on, where you need to spend some time and reach out to that customer and figure out what you're going to do about that. Because quite frankly, if you're never going to collect that, you need to write that off. And then, you've provided the goods or services and you haven't collected on them. I highly, highly, highly recommend that you automate this report. All systems do this. Set it up to send to yourself every Monday and just look at it. Hopefully it's pretty clean and everything's under 30 days and no big deal, but staying on top of this and just kind of glancing at it for 2 minutes once a week will avoid this customer F at $750, 90 days past due. Accounts payable report. I didn't put an example in here because it looks exactly like this, except for it says accounts payable. And not everybody uses accounts payable in a system. So if you, in your accounting system, put bills that you're going to pay and the due dates, then you can run a report. But if you're just paying them as they come in, or you're not recording them until you pay them, it won't show anything on your report. So don't even bother. But regardless of your automation, whether you have it set up or not, keep an eye out on this, because from both sides, you want to make sure that you're staying on top of that. All right. Kind of separate from that, I just want to point out that SCORE does have a lot of resources. These are all Excel templates. I am not suggesting that if you have like a QuickBooks or a Wave or Xero set up, don't go into this. This is more for if you don't have an accounting system, you're using Excel and you want some templates, or you're thinking about a business, here's some options for you. And again, I'll send this out. You can have the links there, so don't worry about that. All right, a few more things I want to hit on real quickly. I know we are spending a lot of time on this, which is good stuff, but I want to save a few minutes for questions. So let's go through some of these. Forecasting. I love forecasting. We talked about this when we talked about the cash flow. This is where you're at today. Where are you going to be going forward? A forecast is an estimate. You know, do you know that your loan payment is ending? Do you know that you're going to double your business? Do you know that you're going to be out for 6 months? And so you're not going to have a lot of business. The forecast concept can be used with an income statement, cash flow, balance sheet, helps you plan for all sorts of things, but it also helps you figure out, like, you know, am I going the direction I need to go in? For anybody who has worked in, you know, companies where budgeting is thing, I hate budgets, but this is a similar concept. It's just a regular update instead of just a one-time thing. Key performance indicators, big term, KPIs, but it's really just a list of things that you want to keep on track of. They are specific to your industry. They're specific to your goals. They're specific to what you want to monitor. This can be, I put a chart up here, but it could be a graph. It could be all sorts of things. It could be automated. It could be something you look at regularly. I would highly encourage you to create your own. And I've listed some resources with some links on here for you to kind of, you know, play around with, look for things that might appeal to you. But really, it's just to give you a flavor of what this is. For this fictional company, I've decided I want to look at my quarterly revenue, and B/W is better or worse. So, you know, for example, I had a goal of 20,000. I came in at 18.5. So I was 1,500 worse than my goal. But really, it's a list of things that you want to track. I want to track how many webinars I've sold. I want to track my client satisfaction rating. I want to track my how many people are visiting and looking at my blogs. It is important, stuff that's important to you. I think it's important to track. I would highly encourage you do it, but I would also highly encourage that you don't spend so much time on it that you're not implementing things that need to be changed. And that's a fine balance for sure. Break-even analysis. Break-even analysis is the point where the revenue and expenses break even, where revenue, anything above this point is income to you. This can be used for before you get in business. It can be used for when you're thinking about, you know, making a change, changing a, you know, a product that you're offering, hiring an employee, things like that. Two quick examples on this. If I charge $100 an hour for my services and my monthly expenses are $9,000, I need to be billing 90 hours a month or 22 and a half hours a week just to break even. So that's that 9,000 divided by 100. Whatever I bill over 90 hours a month will be my profit. So to kind of be take the opposite side of this, if I were to charge $50 an hour and my expenses were still $9,000, that means I'd be working 45 hours a week just to break even. So you can see where this would be a helpful analysis, just to kind of have a high level there, understanding of what you need to do. You can also see why this would be helpful for, you know, for looking at, or I'm sorry, it should be why it would be important to have this $9,000 numbers, have your accounting system have the correct numbers in it. Because if my numbers are really 11,000, you know, that changes this analysis. Example 2 real quick is if my average sale is $25 net of my cost of goods sold. So let's say I sell a candle for $35, but it takes me $10 in materials to make it. So I net $25 on each sale. And my weekly expenses are $2,500. I need to make 100 sales or 100 candles a week before I start turning a profit. So this quick analysis could say, okay, there's no way I can make 100 candles a week. Or, oh yeah, that makes perfect sense. I could sell 1,000 a week. So that's kind of the gut check on some of this. Another good idea, typically before you start a company, but definitely at any point, if you have a need for a business plan, the business plan, it's not just financials. It is so much more than that. It is the marketing side and the sales side and the, you know, what the demographics look like for your target audience and things like that. So very good exercise to go through. And here's some templates that Scorp has that you can, you know, pull down for free. Very good exercise to go through. And also typically if you're looking for funding from a bank or something like that, they're going to look for this. So there's some good resources there. Tax return, the only thing I'm going to say here is you sign it, you're ultimately responsible for it. So whether you do it yourself, have somebody do it, you need to understand what's on there and you need to understand what you're signing because it is ultimately your responsibility. All right, so time has gone fast, at least for me. And I just want to talk a little bit about what we talked about today, which is, understanding your financials and the story that they're telling you. That's so important. It's more than just numbers on a page or numbers you have to produce for somebody else. Use experts to support you. Find accounting help if that's what you need, if that's not your strong suit, so you can spend time on the things that are important to you. And then focus on understanding your financial reports at a high level and then digging deeper. Hopefully, the example I ran through quickly kind of showed that a little bit, but I personally still like that. You look at the big picture and then you kind of dig down a little bit. Don't be afraid to ask questions. Reach out to SCORE if we can help you with any of this. And then, I guess that's a duplicate there, but ask questions of, whomever, whether it's your accountant or tax advisor or whatever. Seek out help from a SCORE mentor. And again, if you are watching the recording and didn't automatically get a copy of the presentation, then definitely reach out to me via email and then I'll get that to you. But if you have signed up or attending here, you'll get that automatically. So don't worry about that. All right, John, I know that time went quickly there, but do you have any questions in the Q&A that we should go through?
Yeah, we've got a couple of questions here. One is there any difference between net profit / loss on the P&L versus EBIT? And to be clear, I don't mean EBITDA.
EBIT, earning before interest and taxes, is what EBIT stands for. They typically are the same. There's probably a nuance in there I'm not thinking of. But it is, they're very similar, if not exactly the same for your situation. But earnings before interest and taxes, okay?
So the second question is, assuming your revenue is very strong, meaning you're exceeding your goal, in that scenario, what would cause a negative cash flow situation?
Oh, you're not collecting on revenues. So you could be selling your profit, your income statement could show a huge revenue number because you've sold a lot of things, but you haven't received the cash for them. So that would be, that would be one example of that. So they could be going in different directions for sure. All right, I'm actually looking at these two. So let me see, I want to get a better idea of what banks look at. So the banks look at these main statements, and they probably ask you to send, if you have an outstanding loan or line of credit, they probably ask you to send some of these in regularly, but they definitely look at these statements. And so similarly, they look at that cash flow statement that I mentioned, the accounting one, where it's financing, investing, and operating. So they want to know how you're spending your money. And that's what that points out. They also look at business plans. So it really depends on what stage of business you're in. If you're looking for a loan, if you have a loan, if it's just an annual review, but banks look at all of those financials there, and then they run their own metrics to ask questions on that. Why did you put marketing costs and 2 other lines of cost as part of revenue? I'm not exactly understanding this, but the cost of goods sold. So if I
that was on the Netflix.
I'm sorry?
It was on the Netflix example, I think.
Oh, so yeah, I probably didn't explain that very well. They had the cost there as well. And so they had that $6 billion of profit. So they had the big picture revenue, and then they showed the cost separately. I probably just didn't explain that very well. So those were the expenses related to that piece of revenue. So they broke out the costs associated with, for example, with the streaming piece of it, how that, the expense of that. So that far right section was the expense piece that they attributed to that revenue stream. All right, what are costs for owners in receiving or participating in? Oh, no cost. No cost. mentoring is free. Go to our website. We'll have a slide in a second where you can see the details for that. Mentoring is free. We have people with backgrounds in all sorts of different industries, different aspects of industries. And, you know, if you call in and need some help with something, and John answers or I answer or whatever, we're not the right person, we'll hook you up with the right people. So don't worry about that. And that can be a one-time thing. It can be an ongoing thing. We have all sorts of different ways that works. Does today's presentation apply to both for-profit and nonprofit businesses? Excellent question. Yes. There are nuances for nonprofit businesses, but the financials look very similar. The financials for a nonprofit business look slightly different, but there's still an income statement that shows the revenue or their sources of income and expenses and things like that. So excellent question. Very, very similar. This is definitely a for-profit that I showed, but all of these concepts are parallel. For AR collections, would you advise on how to do it more efficiently or refer to some attorneys? Okay, so it really depends. The reason I recommend that AR report, I'll give you a concrete example. A business I was working with was surprised by that customer F showing up with 90-day past due, in particular surprised because that customer F was calling for like immediate service requests on a regular basis. So, you know, not taking an adversarial approach, but having that conversation saying, you know, I'd love to help you. However, we need to clear up this outstanding balance. And sometimes in this case, it was just a disconnect between the, you know, people paying the bills and the person looking for support. But it can get to the point where you're not able to collect on that. So, you know, if it's something that you're not personally getting response from, which I would go to first, I would, you know, you make a judgment call on that, whether you personally call or you have somebody in your office call innocently about, oh, you must have lost this invoice, blah, blah, blah. But if you have to refer to an attorney, there are some services that actually will do the collections for you, and they'll take a percentage of what they collect. Last case scenario, though. Regarding the income statement, I didn't see the accountant costs. Is that something that a bank would notice and question? Also regarding okay, so let me answer that first. Yeah, definitely. They would say, I think I had legal and professional services on there, and that's where accountant costs would have gone. They would definitely say, hey, you know, what about this? Or if they were looking at something, they would question why you hadn't taken it into account. That was just an example. It was by no means exhaustive, but definitely as you are, you know, especially forecasting a growing business or a new business, you'd want to include accountant costs in there. Also regarding the forecast slide, there's a huge difference of 16 to 64,000. I didn't see how or why. Not quite sure what that question is. So if you want to re-ask that real quickly and maybe a different way, it's not popping in my head, so I apologize. All right, if I run a service company and my clients pay up front for the year, where would I keep track of the prepaid value, and how do I have to reduce the services are provided? Perfect, excellent question. A little bit more detail on the accounting side. But you saw in the assets prepaid items, and what you would do is there's several different ways to do it. I would check with your accountant, check with your accounting system, but you definitely would count that as a portion, especially if it crosses over years. Not so important if I paid you in January and you had a calendar year. Not super important that you do that, because I paid you for 12 months and we're talking about 12 months, but if you do, if it crosses over, if I paid you in November and it was for, you know, a period of time that crossed over the year, you definitely want to do the accounting around I've earned, and it's really how much you've earned, the dollar amount between the two different years. Oh, wow. Here's a great question. I know we're running short on time, and I'm trying to take a couple more of these. But here's a great one. How much should a small business save in cash in a cash account? And should there be a strategy or plan for taking distributions? Love this question. You should save as much in a cash account as you think you'll need and this is where looking at trends is helpful. So for example, there is no pat answer to this is kind of the bottom line. But if you know that you make all your money in December and then you're going to have more expenses than revenue for the first 6 months of the year, you're going to want to have enough in cash to cover your expenses for those first 6 months until you start being profitable. This is exactly why you need to keep track of cash. This is exactly why you need to forecast out and look at trends and look at seasonality and look at, look at what your plans are there. So it's something to keep track of and keep in mind. But again, there is no, it's similar to on a personal side, they say, 3 to 6 months worth of cash is what you need, which is a generic thought, but you may need more or less given, the revenue and cash cycle that you have. Should there be a strategy or plan for taking, shoot, I lost that question. Sorry. I think it had to do with, it just fell off my screen. I'm sorry. It was about owner distributions. Should there be a plan or strategy for taking owner distributions? And I would say, yes, I think you should do that. Again, keeping with that example that I just gave, you don't want to take a huge distribution in December and then need to put money back into the company January through June because you have no money out there, or you need the cash for the business there. So if you, take a look at your regular, cash flow, your regular income cycle, your regular, what you're expecting in revenues, things like that. That's the best way to look at it. And it's not a one and done. It's not like I targeted this amount and that's it. And moving forward, there is definitely a keep on top of it, keep looking at it. Again, another question that if you reach out to a mentor, we can talk more in detail on that. I'm going to try to hit up on Richard had a question about the forecast that I'm not. I'll try to see if I can get this. I know we're running out of time. Forecast line. Yeah, I'm sorry, Richard. If you want to just email me separately and screenshot what you're looking at or talk about it, I will try to answer that question. But I am not seeing, I'm not quite. Oh, I'm sorry. Okay, here it is. Cash sales. Maybe not, but I'll try to answer this. I think his question is about cash sales. 16,000 in year one, 64,000 in year two. This is my forecast. This is what I think I'm going to do. I just started in year one. I've got a new client coming in year two. I think that I can do 64,000 in year two. This is forecast is just your anticipated educated guess. So if I knew that 16,000 was the most I've ever done, and I don't think that I can do it next year, this might be 14,000. So this forecast is always your educated guess. It is always, I know what's happening. I know I was out for 6 months. I know I hired a new salesperson, whatever things you have in there. So whatever you anticipate is what you build in here, which is the power of why you're doing this. It is like anticipating what's going to happen when all the things that you're predicting come true. So I know there's some more questions coming in, and I will try to gather those and hopefully maybe send out a little bit of information later. But I know we're running out of time, and John had a couple of things he wanted to say there. So I'm going to cut it off there. Thank you so much for all these great questions and for your attendance today and for your thoughts. John, what did you want to finish up with here?
Yeah, just want to let people know that we have some upcoming webinars here. You can see them on the screen. Transitioning a good idea into great business, productivity strategies, franchises. We have a variety of webinars that we do on a monthly basis throughout the year. So please go to our website at www.score.org/North Chicago, and that will go to the local webinars, and that will show you all of our webinars. You can register there. We had a couple of questions about mentoring. Yes, mentoring is free. It is confidential. And if you want to point your camera at the screen, that QR code will give you the same as this link down here, but it is just score.org, North Chicago /local mentors. If you just go to the website itself, you can see there's a menu item called local mentors. And that's it. As Shauna said, thank you for joining us this evening. And we will have this up on YouTube in a couple of days. Hopefully we'll have it before tomorrow, but not always guaranteed, because there's a bunch of other stuff involved in getting it up on our YouTube channel. But in the meantime, take a look at our YouTube channel for any additional webinars that we have put together. So thanks a lot for joining, and we will see you in another webinar here. Thanks.
Thank you.